There is something weird happening in the stock market. Between 1998 to 2008, the stock market has grown by 16%, which is a very decent number. But if you compare it to what's happening lately in the stock market, that's nothing. Sometimes the stock market grows by 16% in less than a month. In the next 10 years, between 2008 and 2018, the stock market has doubled and grown by 101%, which is much more than the previous last 10 years. And if you take the numbers after the 2008 crash, then this number is probably around 150%. In the next 10 years, between 2018 and 2025, well, that's not exactly 10 years, it's a much shorter period, but nonetheless, the stock market has grown by 137%. It seems like with each consecutive year, the stock market is growing faster and faster and faster, as if the fundamentals of the US economy is changing, as if US economy is turning into something that is favoring only the top 10 largest companies. On one side, it seems like great news. The bigger the companies, the more taxes they will pay, the better everybody else is going to get. But that's not what's happening. These corporations, yes, they are making much more money than ever, but they're paying much less taxes. Over the last 30 years, the profits of these corporations has skyrocketed, but their share of taxes haven't actually grown much over the exact same period. So what exactly is happening? The structure of the US economy is changing. It is moving into something called corporatocracy, where the power and wealth is moving from the hands of the government into the hands of a few corporations that are dominating the entire economy. When you hear something like that, it seems like a conspiracy. What exactly are you talking about? But if you dig into the numbers, you will actually be shocked. The total size of the US economy is $30 trillion, and the US economy is the largest economy in the world. This is the most powerful economy that has ever existed in history. On the other side, the total size of the US stock exchange is $65 trillion. So the only question is that, how is it possible that the total size of the US stock market is much larger than the total size of the US economy? It doesn't make sense because these companies are a fundamental or simply a part of the US economy. They must be a portion of the US economy. And the US economy does not just mix up out of these corporations, but rather a huge portion of the US economy are small businesses. If you compare these numbers to the numbers to 2007, before the 2008 financial crisis, the total GDP of the United States was about $14.5 trillion, while the total size of the US stock market was about $18.5 trillion. Yes, even back in 2007, the valuation of the stock market was bigger than the valuation of the US economy. But that number is much smaller compared to today's numbers. This is more than double than the size of the US economy. This is probably an increase of 20%. But investors look at this number and they're like, this is an overvalued stock market, and they started massively selling off their stocks, which led to the 2008 financial crisis. And the total size of the US stock market has plummeted to $10 trillion. And the GDP of the United States was about $14.7 trillion. So the total size of the US stock market back in 2008 was simply 70% of the US GDP. Now, take these numbers and compare them to today's numbers. That's when you realize the fundamental change in the US economy. The system is changing. You see, the system is designed in such a way that it favors the corporations while you're the one who is paying all of the taxes and funding the entire government and funding the system. While these corporations, even though that they're making much more money than they have ever made, they're not paying taxes, they're not doing anything. They're simply enjoying and getting bigger and bigger and bigger. And the only people who are profiting and benefiting out of this system are the people who are investors in these companies, are the people who are running these corporations. I know that this sounds like a conspiracy, but look at the numbers. When you're making your money, you're probably paying taxes. Not probably, but certainly. If you don't pay your taxes, you're going to go to jail. That's how the system works. The money that is left after taxes is your real income that you can go and spend on your lifestyle. And then you also have to pay sales tax and different kind of taxes after that. That's not the system that corporations are following. When you're a company, you first declare your revenue, but you don't pay taxes on your revenue. You have to deduct your expenses. At the end of the day, you will be left with a profit or a loss. If you're left with a loss, you don't pay taxes. If you're left with a profit, that's when you actually pay taxes. But even that tax will be much lower. Let's take the numbers for 2024. So if you actually made $200,000, which is a decent income, you will pay different kind of taxes, from federal taxes to Medicare to state taxes and so on and so forth. Your taxes will be between $60,000 to $70,000. So you will be left with $130,000, and your effective tax rate will be between 30 to 35%, which is the expected tax rate for such a thing. But corporations in 2024 made $22.5 trillion. Think about that number for a moment. $22.5 trillion. Now, the question is, how much taxes did they pay in 2024? $500 billion. So their effective tax rate was about 2.2%. And that's why if you pull out the data, who is funding the US government, you will find out that 95% of all the tax revenue comes from the average middle-class Americans. And corporations are simply paying $500 billion, even though that they have made $22.5 trillion. There are different ways to reduce your taxable income. There is something called an income, and then there is another thing that is called a taxable income. Companies often use depreciation to lower down their taxes. If you're a business and you have built a building, you purchased a property, you build a vehicle, a car, or a truck, you're instantly going to use some tricks to deduct most of the depreciation in the first year, even if you end up using that vehicle for the next 20 years. These accounting tricks allows the companies to maximize their depreciation and lower their taxable income. Another strategy that is pretty often used, especially in the last 30 years, is R&D. You can take every money that you make, invest it back in your products, in your business, buy more planes if you're Amazon, build better iPhones if you're Apple, and you can use that as a business expense and you don't have to pay taxes. Yes, you made trillions of dollars, but you can say to the IRS, well, we used these trillions of dollars to build a new iPhone. That's it. We haven't actually made any money or whatsoever, so we don't have to pay a dime in taxes. Or pay your employees in stock options. A lot of companies today, especially the companies that have their stocks traded in the stock market, they pay most of their incomes to their employees in stock options. They haven't paid a dime in tax. They haven't paid a dime of cash to them, but they are receiving those stocks, which means that the company can take that stock compensation options and use them as tax deductions in their financial statements and reduce down their taxable income. Or you can carry forward your losses. When you're a business and you're starting, you're massively investing. You're taking money from investors and you're investing in a new product, or you're entering into a new market, and you will run for a loss for the next couple of years. Sometimes if you're Amazon, you will operate at a loss for 18 years. And if you ever made a profit sometime in the future, you can take your previous losses and forward them and lower down your taxable income. You have a company that does not operate or reports a profit for 18 years. And suddenly you are a $2 trillion business and Jeff Bezos is the wealthiest person in the world. That's how the system works. You don't pay taxes, but you still end up as the richest person in the world. That's how the system is designed. And that's why these businesses try to maximize their expenses. If there is anything that we can use as a business expense, we will make it as a business expense. So nobody has to pay a dime in taxes. And if God forbid you made a profit, you can use that profit as a stock buyback. So you have a company that is traded in the stock market, and that company has made a profit by mistake. If they distribute that profit to the investors of the company, to the shareholders, those shareholders and investors are going to pay a dividend tax. Do you think they want to pay a dividend tax? Do you think anybody wants to pay a dividend tax that can be as high as 20%? Well, of course not. So instead of paying dividends to the shareholders, we take the money and we will buy back our own stocks in the stock market, which is going to reduce the number of the outstanding shares of our company, which is going to increase the valuation of these stocks, which is going to make our investors wealthier without them paying a dime in taxes. And that's why the stock market over the last 20 years has grown tremendously, because corporations simply started buying back their stocks, investing in themselves, growing their valuations. The focus has shifted from profit-driven companies into valuation-driven companies. So the main focus today is to grow your valuation. Take Elon Musk. He's not receiving any income. Is simply trying to grow the valuation of the business. And now he signed a new compensation package that if he takes Tesla to an $8.5 trillion valuation, he will receive a compensation package that will essentially make him the first trillionaire in the world. And that's why all these corporations in the market today, none of them is focused to pay taxes. None of them is focused to pay money and declare a real profit. Every time they make a profit, they invested back into themselves, which is why we ended up with top 10 tech companies represent a third of the entire valuation, which means that if the valuation of the stock market is $65 trillion, their valuation is more than $20 trillion. Just for the context that the GDP of the United States is $30 trillion. So on one side, we literally have top 10 companies that are valued at $20 trillion, almost the size of the US economy. And for the context, the size of the Chinese GDP is also $20 trillion. So top 10 US companies are as valuable as the second world's largest economy. Do you see what kind of a system that we have created that only favors the corporations and the stock market? So the valuation of the stock market can keep growing while the economy isn't growing much. What if you want to actually take this money out of the stock market and get yourself some nice things? You want to fund your lifestyle. What is the point of all of that wealth that is stuck in the stock market? I don't want that. I want real money in my hands. I want to buy things. I want to buy a yacht. I want to fund my lifestyle. Well, if you ever want money and you want to get it out of the stock market, you don't have to sell these shares. You are going to go to the bank and you're going to use, as an investor, your stocks as a collateral, and you will receive a loan from the bank. The bank looks at you and sees stocks that are valued at a certain amount of money in the stock market. So the bank will provide you with a loan because there is something to back this loan up. If something happens, God forbid, theoretically, these stocks can be sold and the money will be returned back to the bank. So the bank will provide you with that loan. So now you receive cash, but that cash is now in a form of a debt, and debt is not taxed. So you don't have to pay taxes. Now you got yourself real cash in the hand without paying a dime in taxes, and you can go and get yourself a yacht and fund your lifestyle. You haven't sold a dime of shares in the stock market, which continues to grow in the market and keeps making you wealthier, and you haven't paid a dime in taxes while you have access to a real cash. And how the bank will give you that money? Well, today, all the bank has to do is just to type a few numbers in the computers. That money is not real, but you can still use that money and buy whatever you want and fund your lifestyle. So essentially, the real winners of this economy are the investors, are the people who know how the system works and turn their sources of income from a paycheck into an investments. So they keep investing into the stock market, and the valuations of the stock market keeps growing, which keeps making them wealthier and wealthier. But if they ever need the cash, they will get that cash in the form of a debt, and they don't have to pay a dime in taxes. But the real question is, what kind of investments should I buy? What if I'm not a professional investor? What if I don't understand how the stock market works? What exactly should I be buying in the stock market? Well, if I didn't know anything about the stock market and I was a complete beginner, this is exactly what I would do. The first stock that I would buy would be the Vanguard Growth Index. This is an ETF, a financial institution that invests in multiple different companies. So the question is, in which companies does this ETF invest? It follows the benchmark called CRSP US Large Cap Growth Index. This is an index that invests or follows the largest companies in the United States with the highest potential to grow. It does not focus on small companies that have the highest potential to grow. It only invests or tracks the companies that are already well-established companies but still have a lot of room to grow. Let's take an example of NVIDIA. NVIDIA is the most valuable company in the world, but NVIDIA still has a lot of room to grow because we are on the verge of AI revolution and the world needs a lot of computer chips to fund this AI and make AI possible and integrate AI into every part of our society. So there is a lot of potential that NVIDIA will continue to grow. The same can be said about Tesla, Apple, and so on and so forth. So by investing in this index, you're essentially investing in companies with the biggest potential to grow. If you look at their holdings, you will see that more than half of their investments is in tech sector. They of course invest in other sectors as well, but the vast majority of their investments is in technology companies. And the biggest investments they have made are in the top 10 largest tech companies. The top 10 largest tech companies represent a third of the entire stock market. The second ETF that I would invest blindly is the QQQ ETF. There are multiple stock exchanges in the United States, from New York Stock Exchange to many different ones. And one of the most famous stock exchange is the NASDAQ. The companies that primarily invest in tech stocks usually list their stocks in the NASDAQ. So this index follows and invests in the top 100 largest NASDAQ companies. The vast majority of their investments is in technology companies, even though that there is some level of diversification into communication, consumer, healthcare, and so on and so forth. And if you look at the top 10 largest holdings, you see the exact same companies as the previous ETF, because these companies have dominated the entire stock market. You have to understand one thing when you're investing in any of these ETFs, is that whenever there is a crash, whenever there is a turmoil in the market, these are the stocks and the companies that suffer the most because they are growing very fast. Whenever there is turmoil, there is a lot of panic and they can crash instantly. But in the long run, they continue to grow as they keep continuing innovating and making more revenue, making more sales, producing better products, and growing literally the entire AI industry. This ETF alone, since the beginning of the year, has grown by almost 20%. There is some turmoil right now in the market as the deal between China and the United States doesn't seem to be working out, but sooner or later, the market is going to recover. The final ETF that I would be investing is the Vanguard S&P 500. The Vanguard follows the top 500 largest companies in the United States. These are not just tech companies, but these are also all other companies from all different industries. Tech only represents a third of their portfolio. They're also very heavily invested in financial services, consumer cyclicals, communication, healthcare, and so on and so forth. But again, their top 10 largest companies are NVIDIA, Microsoft. These are long-term investments. So if I wouldn't know anything about the stock market, I would simply dollar cost average. So I will dedicate a certain amount of money into these stocks. I will simply buy them, whether the market is growing tremendously or the market is crashing, because I cannot possibly time the market. You can't be expecting these ETFs to grow tremendously because they're investing in a wide variety of stocks, which means that one stock is growing tremendously while other stocks are falling down, but on average, the market is growing, so you're actually making a certain amount of profit. The real way to build fast wealth in the stock market is to go with individual stocks. But again, individual stocks are very risky. If you don't understand what you're doing, you're most likely going to lose. But if you pick a few good stocks, then suddenly you can build your wealth way faster than you can possibly imagine. Nvidia since 2022 has grown by a few thousand percentage points. Nvidia is not alone. There has been Palantir, Oracle, Tesla, and many more stocks. And there will always be new stocks coming out in the stock market that will grow that fast. So if you want to know how to invest in them, you first have to educate yourself. You need to find out how to find valuations, how to know the true valuations of the stocks. Because if you don't have that background, if you don't have that skill, if the stock market crashes, you will be selling at the wrong time. Or you will be buying at the wrong time when that stock has turned into a bubble. So if you want a step-by-step guide on how to analyze stocks and find valuations, then check out the first link in the description of this video. That's it for today, guys. Thanks for watching, and I will see you in the next one.